Hello, my name is Greg Crawford. I am the Director of Content Solutions at Pensions and Investments, and I would like to welcome everyone today to our Trends in Global Investing webinar. We're set for a really in-depth and insightful conversation today on investing around the world. We're joined by a great panel of experts. Our panel includes Elisa Mazen, Managing Director and Head of Global Growth and Portfolio Manager at ClearBridge; Wiley Tollett, Executive Vice President, Head of Client Investment Solutions, Franklin Templeton Multi-Asset Solutions, which is part of Franklin Templeton Investments; Richard Gao, an Equity Portfolio Manager and China Specialist at Matthews Asia; and Sami Moadi, Emerging Markets Debt Portfolio Manager at T. Rowe Price. So by our lineup, you can tell a little bit about how our panel focuses on in global markets, and we're going to get really into that in a few moments. As we know, everyone has seen that the headlines out there today, and certainly things like Brexit and China seem to be sucking up a lot of the air. But we're going to go beyond the headlines today and really dig into what's the real story in markets around the world, and where are there opportunities and what are the risk areas that investors should be concerned with. I do want to point out that we are taking questions from the audience as we have our discussion today. So if you want to click that question button and submit them, we will get to as many of them as possible. And so with the stage sort of being set at that point, I would like to begin our discussion and really kind of get a macro view from our panelists. I'm going to start with Wiley from Franklin Templeton. And Wiley, if you could kind of give us your view of sort of the overall global growth status. I know there are a lot of questions around disconnections between economic cycles around the world. Wanted to get your thoughts on how you see economies around the world and what your sort of outlook is.
You bet. Thanks, Greg. Our view is that basically the current state of growth is broadly positive. As you can see from the slides, it's quite strong in the U.S., a bit slower in the Eurozone and Japan. This is not on the slide, but the emerging markets are increasingly difficult to sort of group and to generalize into one bucket, but on average are also slowing but remain faster growing overall than developed markets. The desynchronization of central bank policy and growth trajectories that you mentioned, it doesn't really seem to have been the headwind that some feared. Looking forward, we see several things. First of all, basically a generally supportive environment for growth in most countries, with moderate inflation, normalizing interest rates, and few large excesses or disequilibriums in most economies. Overall, slowing a bit from where we stood at this time last year, but we believe there's still a very low probability of recession in 2019, perhaps a slightly higher probability in 2020. We're likely nearing the beginning of the end of this very long economic cycle, but our view is that it's not yet the end. Three possible dark clouds that we just need to keep an eye on include potential high levels of debt in certain regions, the U.S., areas of Europe and China, you mentioned, trade policy, of course, and last but not least, sort of geopolitical issues in certain countries and regions. And finally, I think it's important to note that GDP does not equal S&P. That old saying is quite true, that economic growth and capital markets have a low correlation with economic growth over the short to medium term. So the recent volatility indicates that the forward-looking capital market outlook is actually becoming a little less clear, and many markets are still reasonably fully valued. And I know we're going to be talking about that more later in the webinar.
Right. Excellent. Thank you, Wiley. So, Elisa, I wanted to turn to you, and perhaps you can dig in a little bit and tell us a little bit more about why asset owners should consider international allocation, given, the strength sort of domestically that we've seen, even though things have sort of gotten a little rocky lately.
Sure. So on page 5, there's a couple reasons I think that people should consider international, but we'll just go through a few. So if you look on page 5, our longer-term view is that growth in emerging markets has been and will continue to be higher than in developed economies. This is because of population growth, demographic growth, where you have a lot of younger populations that are sort of rising through the income chain in many of those markets is well ahead of the U.S., and the income levels generally are well below U.S. levels. So we think that the dominance of the U.S. market relative to market cap is probably likely to narrow or converge as many of those markets rise as they sort of grow and develop. So you can see here on the left, the United States has 54% of the world's market cap, but only 24% of global GDP. So that's a factor of 2 times. Emerging markets, on the other hand, have a 10% of the market cap, but own a material 40% of global GDP. So that's a factor of a quarter. And while we appreciate that those capital markets are not yet as developed, perhaps, or deep as the developed world, there are still many large companies and groups under family control. We do see changes that we think are positive that will lead to those markets continuing to perform better than developed markets. Corporate governance standards have been improving. You see more shareholder-friendly engagements, both in terms of returns on investments as well as to shareholders. We think that this will benefit markets and companies who are willing to adhere to those higher international standards. You know, we can appreciate that the political backdrops in EM may be a bit contentious. You know, Venezuela grabs a lot of headlines. But I'd observe that, you know, some of the differences between emerging markets versus developed markets, given the environment we're in today, has narrowed somewhat. And maybe perhaps not just the emerging markets have sort of volatile leaders. We think another important development is the inclusion of the China A shares into MSCI indexes, and this has just started with a relatively small allocation, but we do think it will increase in years to come, and that will again increase sort of that EM share in indices. So we do think that there is a convergence that'll happen sort of relative to GDP, and we think that basically the share donor in this game is really the U.S. Now, we have on slide 6 sort of longer performances of the international markets versus U.S. indices. At the top, we have the U.S., and in black, the S&P 500, and in the lower graph, we have the MSCI All Country World ex-U.S. returns. And we show a few periods of times, and it's just really a reminder that there are periods of time when non-U.S. markets actually really do outperform. So you see from 2002 to 2008, there was nearly 2 times the performance coming from international markets relative to the U.S. There was China joining the WTO. There was, you know, lots of good currency performance, about 40% relative performance on FX. So, I mean, there are periods of time. Now, what we've had since the global financial crisis, certainly the U.S. has been on a very, very, very long run here. We can kind of see that. The other thing I'll point you to also are valuations. You can see ACWI valuation sort of sub 13 times. This is as of the end of September versus, you know, closer to 17 times for the U.S. So we certainly know that earlier QE by the Fed relative to other central banks led to a more rapid economic recovery. The U.S. has a more flexible economy. Labor markets are more flexible. We also have a higher tech component in indices as well, and those have performed well. Cash flows on average are better for the U.S. versus rest of the world, and U.S. companies spend meaningful amounts in share buybacks, which has driven better earnings growth in ROE. But we think that that's rather at a peak here. The preponderance of international markets to actually pay dividends over share buybacks has not really helped either. But we think that the willingness of foreign companies to actually start to do share buybacks, especially in markets with sort of net cash or low levels of leverage in markets like Japan and even Europe, will really help sort of change the mindset around shareholder returns and better performance. And we think that that's not particularly priced in. Currency is always another important component in international returns. Certainly that has not flattered performance this year in developed markets and EM, and has really kept, we think, investors away. We think the dollar has the potential to weaken in the back half of 2019 for a few reasons. We've had high U.S. dollar positioning sort of relative to other currencies, so we have a lot of longs in dollars sort of at historic highs. We think the interest rate differentials that we've seen will also likely narrow. as we see QE rolling off in other places as well. We think that when we look at forward curves, we think the Fed is hopefully moderating a little bit on that tightening path, and so we will see over time sort of rates converge, and that will allow better FX performance from international markets. The other thing that we see is in terms of earnings, we see further convergence in earnings performance. The U.S. on the back of on the back of tax cuts has seen really tremendous earnings growth. But again, we see in the back half of 2019 earnings converging between Europe, the U.S. to around 8 to 10%. So we think with sort of similar earnings performance and wildly different valuations, we think it's likely that we'll see some re-rating in the international space.
Excellent. Thanks, Elisa. And we'll get into kind of digging a little bit deeper into that later on, and talk a little bit about sort of your bottoms-up approach to finding opportunities within those broader markets and those broader trends that you just discussed. So thank you for that. One of the things you mentioned was China and the inclusion of A shares in indexes. Richard, I want to get your thoughts, and since you are a China specialist, obviously, get your kind of big picture view of China and how how our audience ought to be thinking about China from a kind of a macro view at this point. And we'll obviously get more deeper as our discussion continues.
Sure, Greg. So from a macro point of view, China has been playing a very important role as a major growth driver in the global economy in the past. But in the recent years, the growth rate in China has been slowing down. So far this year, the economic condition has been particularly challenging, with headwinds coming from both internally and externally. Internally, China started tightening its financial regulations last year and early this year. They tried to solve the country's alarming shadow banking system. And as a result, there is a slowing down in credit growth and squeeze in liquidity. As you can see from the chart on the right, China's credit growth has been declining continuously in the recent 2.5 years. The slowing down of credit growth has quite negative impacts, especially on the private companies, which rely heavily on the shadow banks' funding channels. And on the external side, the escalation of trade tariffs put pressure on the export growth and damage the confidence in the economic outlook. Now, we expect these headwinds in tariffs uncertainties will continue to put pressure on China in the near term. And starting from the second half of this year, though, China began to react quite proactively and has been rolling out measures to try to re-accelerate the growth. So, for example, the PBOC, which is China's central bank, lowered the short-term interest rate recently. And Chinese President Xi Jinping also reiterated support for the country's private sector. And also China's fiscal policy is also turning more expansionary in an effort to maintain a broad economic and market stability. And more recently, Chinese authorities have indicated that there will be more fiscal measures such as tax cuts and corporate bonds issuance to finance local infrastructure projects. So overall, we expect the positive efforts of these easing measures will start to kick in during the first half of 2019. But among the various economic indicators in China, domestic consumption is the one which is still holding up relatively well. And we think ultimately consumption growth will drive the underlying economy in China.
Very good. Thank you. And that certainly is a trend that we've seen, and certainly readers of P&I have read about in the pages of P&I, that the economic shift from sort of being export-driven to domestically driven, and you kind of see that in that chart as well. So thank you very much, Richard. And finally, one of the areas that Elisa mentioned were emerging markets, and Sami Mwadi from T. Rowe is our resident emerging markets expert on our panel today. So, Sami, I wanted to turn to you and get your kind of macro view of emerging markets. I know you don't really want to paint emerging markets in a broad brush, but can you share with us kind of general themes and trends that you're seeing across emerging markets?
Sure. Thanks, Greg. And I would just on that really endorse Wiley's earlier point on not labeling emerging markets in a broad brush. So I'm going to attempt to do that on this chart here, but let's keep in mind maybe during the Q&A session to break out the components of that. And
Sure.
It's great to have Richard on the call here with China being one of the most important views to determine the fate of EM returns. I'm also going to tilt the conversation a bit away from growth and focus on returns. Growth is just one variable that helps drive returns, but the volatility of EM returns, as evidenced on this chart, is far in excess of what could be determined simply from growth. The chart here is showing the historical return profile of emerging market bonds. It looks like a roller coaster because it is. I think often our asset class is talked about from a carry perspective, and certainly over very long periods of time, that carry is a powerful return driver. In 25 years, the asset class has returned on the order of 720% or 8.5% annualized, and on an excess return basis, about 5% per annum. But in any given year, the carry basically has no predictive power of your return. So take the 25-year returns. In only 2 of 25 years, did the return that investors received equal the yield on the asset class. And even if I try to be more conservative and put a 200 basis point buffer on either side of the yield, still in only 2 of 25 years did investors earn that return. So what that means is quite commonly, as pictured on the chart, we have 3, 4, 5 or more points of capital price volatility, and it's an important responsibility of us as active managers to try to call that. The good news is that history is on your side. So in 25 years, this is the 7th cycle of price volatility for emerging market bonds. In the prior 6 cycles, which we've shaded on the chart, if you had bought in that dip, you would have earned a double-digit return within 12 months. And actually, there is some room for error in your entry point. There's basically a 6-month period in any given dip where if you buy these securities, you'll earn a double-digit return on the way up. And that ultimately is just the magic of pull to par on bonds, unless you're entering a meaningful default cycle, which we're not predicting for emerging market sovereigns or corporates. The bonds with a 5-year duration tend to pull to par. So you can get 7 or 8 points of capital price volatility that wipe out your coupon in a single year. We see it quite often, but it's quite rare to have a much bigger drawdown. 2008, 94, 98 were the years that we had those very large drawdowns where you would have made a mistake to be a contrarian. But I would highlight the huge compositional changes in the asset class since then. Most importantly, back to Richard's area of expertise, the contribution of Asia credit has grown from 5% in the 90s to 37% today. And the contribution of our more cyclical countries, so the likes of Argentina, Brazil, Russia, Turkey, back in the 90s, those 4 countries were 50% of the market and 70% of the spread. And today, those countries are under 20% of the market. So we have a much more mature asset class. It's very difficult to get the type of drawdown that we've seen given that compositional improvement. Of course, there are always risks to being a contrarian. While history is on your side, and if you're patient, we're quite positive on the 2019 return outlook, we have to be mindful of those risks. And I think what we're seeing now is a shift from a classic EM external crisis, where it's a balance of payment shock that causes underperformance in the most cyclical countries, in this case of 2018, Argentina and Turkey. We've now seen an adjustment from those more externally vulnerable countries, and we're shifting more to, I think, what's a easier period to call, which is one that's idiosyncratic rather than systemic. So the biggest risks to returns in 2019 are going to be in China on the onshore credit formation. I remain quite positive here, but we can make that a point of discussion. And secondly, Mexico being a risk and some of the early policy missteps of the AMLO administration. Just on that, I'll say today we've had very positive news on the Mexican government's treatment of foreign creditors who finance the Mexican airport, where they're offering a par takeout to those creditors. So that is positive for maybe removing one of the bigger risks going into 2019. I'll pause there and happy to expand upon those themes as we go on.
Excellent. Thanks very much, Sammy. So, I mentioned off the top that, we're going to really dig beyond the headlines, but they are, as I said, sort of sucking the air out of the room, and it does raise the question how asset owners and institutional investors ought to be thinking about these headlines. Can they just ignore them? Are there lessons to be learned from them? And to just quickly kind of touch on the two biggest issues that we seem to be facing. And Wiley, I'm going to turn to you. And funny enough, Wiley is joining us today from Hong Kong, which is right at the kind of on the doorstep of one of the most headline-inducing trade skirmishes, and with China, obviously. So, Wiley, just broadly speaking, these trade issues that we see in the news, how should investors be thinking about them, or should they just be ignoring them?
Yeah, it's a great question, and as you said, I have just spent the last several days touring around Southeast Asia and several emerging markets, and based on my observations, trade, at least in the region between countries here, is going great gangbusters. The big trade question that's been getting all the headlines has been sort of the tariff question, with the U.S. Imposing tariffs on certain commodities and certain countries. Our expectations and the charts that were included earlier in the deck indicate that trade is expected to slow somewhat, and our belief is that's probably more related to moderating overall economic growth than the tariffs, though the tariffs are an issue to watch carefully. And the reality is that the U.S. Was and is actually subject to some significant trade barriers and imbalances. I think you've probably seen the headlines that autos in the U.S. were subject to a 40% tariff on importation into China. And that type of tariff, that steep type of tariff, is not uncommon in other parts of the world. So the U.S., despite coming under great criticism for coming up with some of these sort of compensatory tariffs, had real issues to try to address. So our hope, and we believe the highest probability outcome over the short term, is that we'll arrive at negotiated, imperfect, but overall probably more economically efficient trade agreements, and that the tariffs could actually be brought down overall. And as you might remember from your Economics 101 course, tariffs are a net negative, and so reducing tariffs could be a net positive. There's a lower but still material probability that these trade positions harden, and we end up with a full-fledged and sort of sticky trade war that starts to impact actual economic growth more dramatically. But that is not our base case. Our base case is that these tariff negotiations will result in, as I said, negotiated, imperfect, but overall better trade agreements. And separately, and sort of stating the obvious, the back and forth on these trade and the related communications, particularly the tweets, have been driving volatility back up in many equity markets. And it's interesting that most of this volatility has not been confirmed by sort of mirrored volatility in the bond markets. The bond markets have had their own issues, but the trade volatility in particular has not necessarily been completely confirmed by the bond market. So given that, we believe it's primarily the sentiment-driven volatility versus sort of a dramatic underlying change in fundamentals.
Right. Excellent. Thanks very much, Wiley. The other big headline out there certainly today is around Brexit. UK Prime Minister Theresa May facing a no confidence vote today. Elisa, given your sort of global view of things, that whole Brexit issue and any sort of knock-on impact on broader Europe, again, the question is how should investors be viewing those headlines, and are they a factor in terms of investment strategy or thinking?
Right. So a few certainties we know about Brexit and issues in Europe, like Italian politics. And frankly, that's something that we have very little ability to predict outcomes with any type of accuracy. So, the fact that there is sort of a no confidence vote that's being voted on today by the Conservative Party and Theresa May, this was not really in anybody's sort of thinking even sort of a week or two ago. So it's always interesting to sort of watch these sort of developments as they sort of occur. But, although they're challenging for investors, they also present opportunities as well. So as bottom-up stock pickers, we like to find attractive entry points to buy quality businesses. And these are the type of events that allow us to really find and evaluate ideas where the baby's kind of been thrown out with the proverbial bathwater. So there's been enormous outflows from the UK since Brexit. Something like £1 trillion has actually left that market, which is quite a meaningful number. So you've seen, enormous outflows. Domestically oriented companies have really been kind of trounced and derated. So there's some interesting areas to evaluate. There's some areas. I mean, we do see a slowing somewhat in the economy in the UK. But the great balancer is always the currency. So you just have to be mindful of sort of who could be negatively impacted by that. But the contrary is there's usually somebody that always benefits from that as well. Italy, has been a long-term problem for Europe, but today, they actually announced a lower budget than they had initially presented to the EU, and that seems to be making people a little bit sort of happier. But that economy has not really grown in a decade. It has underperformed all major economies. They really have not taken meaningful reform on board like some of the other European economies, which have really benefited from that in terms of seeing unemployment come down, better sort of consumer behavior, et cetera. So, Italy is a market where generally you have an election every year or every other, and we don't think that that'll particularly change. As growth investors, Italy has been a difficult market, and although it's really not a particularly meaningful part of portfolios for us today. Germany has appeared to sort of pass the baton in a pretty straightforward way. Merkel's ally is going to be the new party leader, so I think things seem to be better, and that's important because it's one of, it is the most important market in Europe. So although these events create noise, volatility, market dislocations, we always think it's important to separate the headlines from the companies, the fundamentals, and try to find these good businesses at attractive price points, which this type of volatility seems to present itself. In terms of how do we sort of think about the riskiness and what to do about that, it's really all down to diversification, adjusting for active weights, such that any of these type of risk events, when they appear, people don't typically anticipate this too much, doesn't upend performance in a meaningful way. So we don't want external macro events to impact portfolio performance, and so the way that we adjust for that is in position sizing and always trying to evaluate for the right amount of risk-adjusted upside.
Excellent. Great. That makes a lot of sense. So thanks for that explanation. So Wiley, I'm going to turn the floor back to you. You mentioned economic cycles off the top and the sort of disconnection globally of economic cycles. I wonder if you could tell us a little bit more about that and how that important that is for investors and how investors might sort of prepare for that coming shift in terms of whether it's their allocations or what have you.
Yeah, certainly. So as I mentioned, we have a saying that GDP does not equal S&P. It's just sort of shorthand to indicate that underlying economic growth and capital markets actually have a low correlation over the short and medium term. In the short term, capital markets are really driven by sentiment and investor behavior. Longer term returns are driven by economic growth and valuations. So after 10 years of coordinated central bank activity following the great financial crisis, that really drove global liquidity and valuations up across almost all asset classes. And it was quite a global phenomenon, actually. It was pretty widespread. That is starting to change, and we're right in the middle of watching that change because we're moving into a tightening cycle in some countries, whereas other countries are still relatively sort of in a relatively loose monetary policy situation, certainly tighter than they were a year ago, but not necessarily tightening. While the U.S. Is already rolled out several interest rate increases and has several more on the docket, and so I think another sort of cliche, but it rings true, is don't fight the Fed. And that's a real and topical subject, and we've seen that drive. We've seen some of these activities and some of that sort of unsynchronized changes in interest rate policy drive returns to a more typical level of volatility, certainly in the U.S. and in many other capital markets. We've just released, actually, our 2019 long-term capital market expectations, and basically what we're expecting is slightly lower returns across most asset classes, across almost all regions, and a return to a normal higher level of volatility. It doesn't feel normal right now because we've had suppressed volatility for several years, but we're seeing volatility climb back up to sort of more normal and typical levels. So your second question was sort of what should investors do to prepare for that shift?
Right.
And as I mentioned, given that fundamental economic drivers like growth and interest rates are in transition from this era of coordinated quantitative easing, but they don't yet appear to really be in excess or disequilibrium right now, we're advocating sticking very close to your long-term strategic allocation. In other words, now is probably not the right time to be really long or short in a different asset class versus your strategic asset allocation. That's what Franklin Templeton Multi-Asset Strategies does, is we do strategic and tactical allocation. And right now in our portfolios, we're really close to our long-term strategic allocation, and our tactical allocation positions are quite modest. We've grown incrementally more cautious over the past 3 to 4 months and have sought to add areas of defensible space in our portfolios as we move into 2019. And a few examples of defensible space. So first, we're modestly overweight short-term treasuries and cash. There's really almost no premium to go longer duration. As you might have heard, sort of the yield curve is very flat and it's actually inverted in a few spots. So there's really no premium to go longer. And having short-term treasuries and cash creates good defensible space. The yields are much higher than they were just several years ago, so the sort of opportunity cost of treasuries is a lot lower than it was. And you have dry powder to take advantage of some of those re-ratings that Elisa mentioned a bit earlier. A second area of defensible space is we're looking for ways to mitigate equity risk in a variety of ways, not in a dramatic way, but sort of nibbling around the edges to cut down your exposure to equity risk. In the long run, equities are the primary way that most investors generate returns. But during times of volatility, they can hurt. And so smart beta strategies that utilize active management but rely on smaller, more frequent, and lower active risk bets that have lower betas is one way to do that. Risk premia strategies that basically are less correlated with equities but yet still have a positive return. The third strategy that can create defensible space that I'll mention is really continuing to look for opportunities to add allocations to private real assets, including real estate. We think many of these private assets and real estate in particular have good exposure to factors that are such as inflation that can be protective over the long run if inflation starts to jump up. They are not as subject to the whims of investors and short-term investor behavior because they're illiquid and they're difficult and expensive to get in and out of. And interestingly, these private markets are growing more rapidly than public markets. Public markets, stock and bond markets, particularly in the U.S., actually shrinking slightly, whereas in the private markets continue to grow. So those three areas really are what we're advocating for investors and implementing in portfolios to create that defensible space.
Okay. Makes a lot of sense. So thanks for that, Wiley. Richard, you had mentioned earlier the shift in economic drivers in China, and I wondered if you could take us a little bit more in depth on that point, a little bit about why that's important to investors. What are the things that they really need to be paying attention to as the economy in China continues to shift, and then perhaps you can talk a little bit also about kind of the investment opportunity.
Yeah, so I think many investors still think China as a global manufacturing center, and that its economy rely mostly on exports as well as fixed asset investments such as roads, bridges, and highways. So I think that's why people are so nervous about this tariff trade issue. But if you go back to slide 7 and take a long-term perspective and look at the major contributors of the economic growth over the past decade, you will find that exports and investments are playing less and less of a role, as you can see on the left side of the chart. On the other hand, the domestic consumption has taken over as the main driver to the economy. But as a matter of fact, China's exports to the U.S. has been declining from around 10% of the total GDP to only 2% over the past 10 years. So China's consumption growth is supported by its strong real income growth, its high household savings, and also low household debt. To just give you an idea of how strong China's consumer power is, take the example of China's retail sales, online retail sales. The online shopping reached a record number in China during the so-called Singles Day, which is the Chinese version of the U.S. shopping event, the Black Friday. So on November 11th, 2018, which is the single day, the online sales reached $31 billion. This is compared to around $6 billion of sales in the U.S. on the Black Friday. So China basically sold 6 times more goods and products online on that day versus the busiest shopping day in the U.S. So we believe that even in an overall slowing economy now in China, there are plenty of investment opportunities in China's domestic consumption areas. And this is the area that we here at Matthews have been focusing on. And talking about specific investment opportunity in China, as you asked, Greg, just now, I think for investors who are interested in having some long-term exposure to China, it may be an interesting time to take a look at its domestic Asia market. Now, historically, the Asia market were off-limit to foreign investors. But during the recent years, the government has been gradually opening up to the domestic, domestic stock market to foreigners. And as Elisa mentioned just now, earlier this year, China's A shares were added into the MSCI Emerging Market Index. So overall, the Asia market is huge. There are more than 3,000 listed companies with a total market cap of more than $6 trillion US. It is only slightly behind Japan and is bigger than the overall market in Hong Kong. The good thing about the Asia is that it provides a wide-ranging investment opportunity in every aspect of China's domestic economy. Take consumer discretionary, for example. The total number of listed companies in the sector are almost 3 times as much as similar companies listed in Hong Kong. For us, this provides a good hunting ground for picking some solid companies to invest. Investors may also notice that historically, the Asia market is known for its high valuation, high volatility, and retail-driven market behavior. This is very true. But over the past few years, its valuation has really been coming down quite substantially. And at the current level, the A-shares overall valuation is more cheaper than Hong Kong-listed Chinese companies. I've been covering these 2 markets for many, many years, and this is really the first time I have ever seen A-shares selling cheaper than Hong Kong-listed companies. And in the meantime, Chinese regulators have been tightening rules and regulations regarding disclosure and corporate governance. So as a result, we are seeing more and more institutional investors from both domestic and international side. So I think it's a very interesting time to really take a serious look at the investment opportunities in the Asian market.
Right. Excellent. Thanks, Richard. And that 31 billion figure that you cited for Singles Day, I mean, it really also speaks to that growing middle class in China, and that's going to have some long-term staying power. And certainly the idea that you mentioned about corporate governance, long been an issue for investors looking at China. So that's another positive sign. So thanks for that. Sammy, I want to bring you into the conversation here and get a little bit more around emerging markets. We've talked a lot kind of around the equity side of investing. You obviously focus on debt. Can you tell us a little bit some of the differences between emerging market equity and as you call it, the sort of three flavors of emerging market debt?
Sure. I'm going to start, Greg, with just a common mistake that I see from asset allocators. Almost, I'd say, over 85 to 90% of asset allocators that I meet make this mistake. And the opening premise that they have in portfolio construction is that long-term equity returns are greater than long-term bond returns, and therefore adjusting for volatility will have higher equity than debt allocations to meet the liability profile. So that is an arithmetically true assumption in developed markets. The mistake that I see is that they carry that forward into emerging markets. And it's just not true by any measure when you look at the data. So take a 25-year longest available sample of the two asset classes. Emerging market hard currency debt has returned 720% cumulative, which I mentioned, whereas EM equity has returned 230%. So bonds have outperformed stocks by 490% cumulative, or 4% a year compounded. That surprises a lot of people, but it actually makes a lot of sense when you dig into the data and the drivers of that. There's two big reasons for it. So one would be the drawdowns in equity, or the periods of negative return, are so much more severe than you have in fixed income. A down year may be minus 30%, minus 35% versus the minus 6 or 7 that you would typically experience in bonds. Secondly, and equally important actually, is the FX component. So what I quoted you were dollar returns, but it would be the same if I ran that on sterling or euro liabilities. EM foreign currencies over 25 years, during the greatest period of reform for these countries, during the greatest period of inflation convergence for these countries, EM currencies have been, by any measure, a very poor performing asset class. They have depreciated more than in line with the inflation differential of the countries, and so equity investors have bared the brunt of that currency volatility. So if you take a step back and think about a portfolio construction concept where actually bonds have outperformed stocks, you may get to a very different allocation decision. What I'm showing here on this slide 10 is just the 10-year return profile and some of the characteristics that you have available to you in the different asset classes. The numbers I've quoted you so far are referring to the hard currency sovereign debt, or the MBIG. The local currency debt obviously is going to share the volatility profile that its equity counterpart does. I will say, if you feel very constructive about EM in 2019 and you want to get the biggest bang for your buck, then buy equity, because you will get those plus 30, 40% up years if you time it right. But from a long-term compounding perspective, particularly adjusting for the volatility profile that you're receiving, the 19% annual vol in EM equity, we do feel that EM fixed income is under-owned, particularly by U.S. investors who have that dollar liability profile. I'm talking about upside here, but I think it's equally important to talk about the downside. So on slide 11, what we have here is just the last cycle of drawdowns, and I'm only looking at the last cycle because the constituents of the data set that we're sampling change over cycles. And this is showing just in periods of drawdown, how do the asset classes perform. And again, you see EM bonds in light blue, the EM local currency bond market, and EM equity in yellow having the most significant drawdowns, whereas the more defensive properties can be found on the hard currency side. And I do want to make a point here, EM corporates, which is the newest asset class available to investors carrying about a 6.25% yield today, is actually a more defensive asset class than EM sovereigns. I think often people think of a drawdown and corporates would tend to underperform sovereign debt, but what you really have is a big compositional difference where the corporate market is effectively only lending money into mainstream countries. It has much more of an Asia bias to it, whereas the EM sovereign market, the countries that actually have spread on them are much more of a frontier profile. So you're buying Argentina, Ukraine, Venezuela, versus a corporate market where most of your exposure is going to be in Mexico, Brazil, or China. So in periods of just the negative return, isolating the negative return, EM corporates tends to outperform. In 2018, it's only down 2%, whereas the other EM bond markets, the sovereign side, is down over 7%, and the local currency bonds are down over 9%. So if I sum that up, if you're really positive on EM in 2019, then go buy EM equity. If you're nervous about being too early, or you're trying to make a more deliberate long-term allocation, rethink the mix of stocks and bonds in your profile. And I think you'll find that empirically EM bonds earns a higher portion. But if you're still reticent about maybe being early or just that the next decade of bonds is going to look very differently than the last decade, then think of EM corporate given the more defensive profile that has been evidenced in the last 5 years vis-a-vis the sovereign side, which is where investors have more traditionally allocated to.
Very good. Lot to think about there, Sammy. So thanks for that. And certainly, I think folks on the phone tend to be those longer-term investors. So rethinking that mix of stocks and bonds in EM may make sense. So very good. So Elisa, I want to get your thoughts on a couple of things you've mentioned. You had mentioned kind of growth earlier, and I'm wondering if you're seeing a move from growth to value. I mean, that's certainly an issue that investors grapple with all the time when they're thinking of sort of equity investments. And then you also talked about a couple of, the bottom-up approach, and wonder if you could tell us a little bit more about that. So if you could address those two issues for us, that would be great. Thank you.
Sure. So do we think there's been a move from growth to value? Not really. We don't think there's been a material shift from growth investing to value investing. What we have seen is that with the rise in interest rates, we've seen many growth stocks derate from very high levels, especially companies that have more value in, let's call it, the terminal value of their business. So these are companies that don't have a lot of maybe upfront earnings, where earnings are sort of the promise of the future. So we've seen sort of a real compression from particularly that space. We call it emerging growth. The other thing that we're thinking is, we're looking at is companies that are embarking on investment plans. Companies grow in a lot of different ways. So as they spend to grow or make acquisitions to augment their growth trajectories, those have also been sold off as well, primarily because sometimes new acquisitions impede margin growth, potentially decelerate earnings a little bit. But we think that those things are rather temporary, and you should look through that. What we see in value investing is that generally that's led by financials, industrials, cyclicals, and materials, financials being the largest sector. Developed markets have been very tough, and I'm talking about international markets, have been very tough for financials. And we think that they'll continue to struggle to make any sort of meaningful headway with kind of this ultra-low rate environment. Now, that could change. We know that balance sheets have been cleaned up. We know that the capital levels are generally at pretty good levels. So that could change in 2019 and 2020. So we think they could emerge at some point as structural growth stories. So we think there is potentially a growth angle. We think it's a bit early there. The materials and industrial cyclicals we think have underperformed over, the concerns on trade wars, et cetera. Whether we're going to have a recession or not, we've seen big compression in multiples. Potentially, those could be attractive stocks as well. But the thing that really concerns us about value, and the thing you have to, we think, be aware of, is when you see value stocks that have disruptive trends to their business models, which could cause earnings to stagnate and multiples to derate. So what we're seeing is a lot of technological change, a lot of new business models that are coming in and disrupting large traditional businesses. We think that's something that you have to be sort of acutely aware of, because then you fall into the value trap. So it's not really about buying an ETF and just like letting it index, oh, I'm buying the cheapest part of the market. We think that sometimes things are cheap for a reason, and watch this space in terms of technology and disruptive trends. New business models, we think that that's something to be quite cautious on.
Okay.
So as I said, as you mentioned, Greg, we do have a very bottom-up approach. We favor sort of higher quality businesses that generate a lot of cash. In an environment like this, where things are a little bit sort of questionable, things are slowing a little bit, we think that that's something that holds us in very good shape. So our approach to growth is very valuation-based. We do look for mispricing opportunities to buy into good quality businesses. Quality for us means product, process, platform that grows for an extended period of time above the markets, but it also refers to balance sheets as well, because we believe that companies need to have that self-financing mechanism that allows them to grow for long periods of time and without having to sort of avail themselves of markets, either debt or equity, which may be unattractive.
Okay. Very good. Thanks so much, Elisa. So we're coming up to the last few minutes of our time together here. So I want to get a perspective from each of our panelists on kind of a key takeaways. We've obviously covered a lot of ground. It seems like we've sort of gone around the world in our discussion today on investing globally, which is apropos, obviously. But I wanted to ask each of you on the panel kind of what are your 2 or 3 key points for our audience to sort of take away, perhaps, do a little more due diligence or follow-up on. And I'm going to stick with you, Elisa. I mean, one of the things you talked about was, the importance of separating headlines from companies and fundamentals and doing that sort of thing. You were just talking about kind of the growth versus value question. At the end of the day, as they say, what are your 2 or 3 key points for our audiences today?
So we think the international markets are attractive today, especially because the political macro noise is sort of at such an accelerated or elevated level. And we're seeing a lot of good opportunities to buy into some of these new disruptive businesses. So we're happy to be having those opportunities. You always have to look at sell downs as an opportunity rather than as something to be concerned with. We think international can perform well relative to U.S. portfolios, and we see improvements on the horizon in terms of ESG, sort of more forward-thinking corporates. That could lead to meaningfully better performance relative to the U.S. and lower valuations, earnings improvements in emerging markets, et cetera, we think are the reasons for that.
Very good. Thank you. And Wiley, you had obviously covered a lot of ground. You mentioned off the top kind of the 3 dark clouds that you sort of see and have on your radar screen. Obviously, the key point of GDP does not equal S&P. But when we boil it down, what are the key takeaways that you would like to leave our audience with today?
Yeah, so I would say that as in all, or at least most things, that sort of sticking with the long view and sticking to your strategic asset allocation, building in some defensible space, keeping an eye open for possible Fed over-tightening and hardening trade positions. Those are all things that I think would serve an investor well. In particular, just keeping eyes open for the long view, not getting too panicky or worried about short-term noise in the markets. That would be my key takeaway.
Okay, very good. And I think it's super important because there is certainly a lot of noise out there that can kind of take our attention away from, what's really important in the broader trends and company fundamentals and things like that. So I think that's a great point. So Richard, you talked a lot about opportunity in China, the changing sort of nature of economic drivers in China, as well as the changing nature of kind of investing in China. What are the couple of real key points that you want to leave us with today?
Yeah, so I think in the near term, China's economy is facing some challenging headwinds. The economic growth will probably continue to slow down into early next year. But China has been taking measures to try to re-accelerate the economy. and it has increased lendings towards private sector economy, taking a more easing monetary policy. But more importantly, China has been successfully transforming its economic development model towards more relying on the domestic consumption and services, as we discussed just now. For longer-term investors who are interested in riding on this future growth driver in China, we recommend that they take a closer look at the domestic Asia market. It has a broad range of listings coming from the domestic consumption area. It is trading at a more reasonable valuation now, and it has a growing institutional investor base.
Excellent, very good. Certainly, valuations is one of those key metrics that all investors keep an eye on. So that's an important point to make. And also, I do think that as more institutional investors get involved, that will kind of get others encouraged and look more deeply into doing the same thing. So thanks for that, Richard. And finally, Sammy, again, looking at emerging markets, you just gave us a great overview of sort of the debt, investing in debt versus equity across those markets. As we sort of depart our discussion today, what are the couple of key takeaways for us that you would leave us with?
Thanks, Greg. So hopefully evidence why we have a constructive outlook for emerging markets in 2019. I do think when you look at the historical shape of returns, that history is on your side for positioning. And the last thing I'll say is don't wait for the good news. When you have returns that are as volatile as what we have endogenous to emerging markets, if you wait for the good news to happen, the trade is gone. So people who succeed in this asset class tend to, number one, have a long-term perspective, so would endorse Wiley's earlier point, and just get that compounding nature of the return. But two, are willing to be an informed contrarian, because if you wait for the good news, investors would have already kind of sought that out and put it into asset prices. So a lot of the trade is had when you're willing to be that contrarian. And lastly, just to rethink, if you agree on the emerging markets outlook, just rethink your allocation framework, because the lessons of developed markets, equity versus bonds, shouldn't necessarily be applied into emerging markets.
Very good. Excellent point. So thanks for that. A lot to think about in our broader thinking about international investing. So I appreciate our panel today joining us to have this wide-ranging discussion on international investing, or global investing, I should say. So just to remind everyone, we've been joined today by Elisa Mazen, Managing Director, Head of Global Growth and Portfolio Manager at ClearBridge, Wiley Tillett, Executive Vice President, Head of Client Investment Solutions at Franklin Templeton Multi-Asset Solutions, which again is part of Franklin Templeton Investments, and Richard Gao, Equity Portfolio Manager and China Specialist with Matthews Asia, and Sammy Muaddi, Emerging Markets Debt Portfolio Manager at T. Rowe Price. And just one final plug, Wiley is joining us from Hong Kong, so he wins the award for the longest phone line. So I appreciate him staying up late to join us on this call today. Those firms, ClearBridge, Franklin Templeton, Matthews Asia, and T. Rowe Price, are the sponsors of the Trends in Global Investing supplement, which is in the current issue of Pensions and Investments. So I encourage you to poke through that. These four folks are quoted in there, and some further insights are available in that supplement, which is also available at pionline.com/trends in GI. So with that, my name is Greg Crawford. I am the Director of Content Solutions at P&I. It's been my pleasure hosting and moderating our webinar today. So thank you all to the audience for joining us. I hope everyone has a healthy and happy holiday season, and we look forward to meeting up again in the new year on another P&I sponsored webinar. Thanks very much, and have a great day.